Your required minimum distributions, or RMDs, could push you into the highest tax bracket of your life at the exact moment when you thought you'd finally be able to enjoy your retirement. And if you don't plan, you could wind up paying hundreds of thousands of dollars more in taxes than necessary. And this is a reality that many of the people who are now my clients face. I have seen it firsthand too many times to count. You do a fantastic job saving because that's what you're taught to do. And then as you get older, now you're paying more in taxes than you were during your peak earning years. Or even worse, you didn't even get to spend your money because you passed away, and somebody who inherited your money is now forced in the highest tax bracket, essentially wiping away almost half of your hard-earned dollars. Today I'm going to help you solve that problem. And before we get started, my name's Knoll. I'm a certified financial planner and founder of NAB Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. Most people spend their entire careers paying into pre-tax accounts like a 401k or a traditional IRA. You get the deduction now, the money grows tax deferred, and then is taxed as ordinary income when it's distributed in retirement. But here's the problem. Assuming you were born before 1960, you will be forced to start taking money out of those accounts at age 73. If you were born after 1960, you're forced to start taking at the age of 75. And at this point, the IRS essentially steps in and says, it's time to start paying up. You must start taking these required distributions, whether you need the income or not. And here's what most retirees fail to recognize. Your RMDs will add to your taxable income base. It can push you into higher brackets. It can trigger Medicare IRMA surcharges, and it can increase the rate at which your Social Security benefits are taxed. For high savers with $1 million or more in pre-tax accounts, this can quickly become what I call the RMD Tax Trap, where required withdrawals force you to pay more in taxes than you ever did while you were working. And the most important thing is that this is completely avoidable with prudent planning during your early retirement window. Let's take a quick look at a real-world example. Let's assume you have $1.2 million in traditional IRAs. You're retiring at 65, and you plan to live on $80,000 a year from Social Security and other brokerage accounts you have. At 73, their first RMD is roughly $45,000. That's on top of Social Security and any other income that they take. Suddenly, their taxable income is going to jump above $120,000, potentially pushing them into the 24% tax bracket or higher. And this doesn't even account for how the RMD will grow as they enter their late 70s, early 80s, and beyond. This is where people start to end up with issues, is that as they grow older and that balance continues to grow, the RMDs get bigger and bigger, forcing you into higher tax brackets. The first strategy you can utilize to avoid the RMD tax trap is Roth conversions before the required minimum distribution age. These conversions will reduce the future RMDs you have to take. Roth IRAs also don't have required minimum distributions themselves, which gives you more flexibility as to when you can access those funds, and the growth is tax-free and the distributions are tax-free. So for somebody who's age 62 and retired and delays to the Social Security, you might have a 10-year low-income window before RMDs kick in at 73. That's prime time to strategically convert portions of your IRA while staying in a lower tax bracket. Think of this as tax bracket filling. Each year converting just enough to maximize today's lower rates without creeping into unnecessary surcharges. This works especially well for people who do not need the distributions to live on. It will help them pay taxes at a lower rate and then in turn have tax-free income later on in retirement should they exhaust all of their funding sources. Also, from an estate planning standpoint, leaving someone else money in a Roth IRA is more advantageous than leaving it in a pre-tax account. That's because of the 10-year rule where the government essentially forces you to take distributions from that account and completely exhaust that account over 10 years if you're a non-spouse beneficiary. So inheriting a few $1 million in a pre-tax account as a non-spouse beneficiary will likely push you into higher tax brackets, assuming you're working yourself. But if you were to inherit those funds in a Roth IRA or a Roth 401k, that 10-year forced schedule does not have you incur any extraordinary income tax expense. The next strategy works for you if you're charitably inclined and already started your RMDs, and here's how it works. You can transfer up to $108,000 per year as of 2025 directly from your IRA to a qualified charity. That distribution counts towards your RMD. But here's the magic, it's not taxable income. Instead of taking the RMD, paying taxes, and then donating cash, a qualified charitable distribution lets you skip the tax entirely. This can lower your AGI and help you avoid IRMA surcharges. For high-income retirees, this is one of the most efficient ways to reduce your RMD burden while supporting causes you care about. Utilizing this strategy in conjunction with Roth conversions is especially powerful. Let's go over a brief example. And let's say your required minimum distribution for this year is $125,000. The first $108,000 can be taken tax-free if given directly to a charity. The next $17,000 will be recorded as ordinary income. But let's also assume that you have another $50,000 before you then fill up the 22% bracket. You can convert that money and pay $11,000 in taxes. So in all, you've taken $175,000 from the account and only paid $11,000 in taxes. Whereas had you not utilized this strategy and just simply taken the RMD as it was given, you would have paid roughly $29,000 in taxes based on that same required minimum distribution amount and the same tax brackets. The third strategy is to use tax-efficient account sequencing, and this is another often overlooked tactic. You want to coordinate withdrawals across taxable, tax-deferred, and tax-free accounts. This is what I like to call my taxless retirement blueprint, and I recently made a video on it, and I recommend that you check it out because it'll go over the strategy more in depth than this overview I'm going to do right now. But this can help you significantly reduce or completely eliminate taxes in your retirement plan. And here's the general framework. First is you want to utilize strategic Roth conversions. You want to convert up to the standard deduction or the itemized deduction if you're able to itemize your deductions in a given year each year. For two retirees over 65, the standard deduction is $46,700 this year, thanks to the new enhanced super deduction you're allowed to take. Next, you want to tap your brokerage account. Take any additional income you need up to the max capital gains limit on your brokerage account. For married couples, this is $96,700 a year in taxable income. The next thing you want to do is to choose your optimal approach. If you want to convert more into Roth dollars to use your lower tax brackets effectively, do so. But be sure to reduce your realized capital gains by an equal amount so you don't cross the capital gains threshold and then make your capital gains taxable. Finally, you want to use your Roth withdrawals for later on. Roth funds provide that tax-free buffer, so building your base here and letting it grow until it's your last funding source is usually your best bet. This sequencing takes advantage of low-income years and sets up a more stable, predictable tax profile in retirement. The biggest mistake I see retirees make, though, is waiting until RMDs start to think about your taxes. And here's the reality. If you do nothing, your IRA will grow, which means your RMDs will grow. By 80 or 85, assuming you started with a 7-figure portfolio, you could be forced to withdraw up to 6 figures annually, whether you need the money or not. This means more taxes, higher Medicare premiums, and less control over your retirement. By acting early, often in your 60s or 70s, you can shrink future required minimum distributions, manage your tax brackets, and create more flexibility for your estate. So here's your key takeaways for today. RMDs can create unexpected tax spikes at a time when you're least prepared. Proactive planning in your 60s and early 70s through Roth conversions, QCDs, and withdrawal sequencing can help you avoid this trap. But if you wait until RMDs begin, you've lost your best window to act. But even if you're starting late, there are ways to optimize your taxes both in the short term and long term. At NavWealth Partners, we specialize in proactive retirement tax planning. Our goal isn't just to help you invest smarter, it's to help you keep more of what you earn. Investing returns mean nothing if they are being eaten up by excess taxes. Picking the right allocation is step 1. Step 2 is maximizing your current income picture and your lifetime tax outlook. Remember, smart planning today can save you hundreds of thousands of dollars in the future. Thank you so much for watching, and as always, make smart money decisions.